Welcome to the latest episode of Quest for Twice. In this episode, I'm going to discuss the valuation level of the market. Why? As a value investor, it is important to understand of the state of the market so that I can decide the investment strategy and the tactics. I showed this graph in last episode. So this is the S&P 500 enterprise value over EBITDA ratio. And this is very informative in terms of to understand how the market valuation as a whole and for different sectors. So let's spend some time to look into the details because there is a lot of information in this graph. Enterprise value over EBITDA, it basically it's used as a rule of thumb to understand how many years it'll take for the investors to get paid off, because EBITDA is a proxy for cash flow before interest and tax and capital expenditures. And enterprise value is the total value of the capitalization of the company as well as its debt level. So they are stock investors and debt investors. Add the total investment together divided by EBITDA gives a proxy for number of years these investors will be paid off. Then after they are paid off, of course, then all the future cash will go to the stock investors. Looking at this graph, we can see that the EV over EBITDA ratios are very different across industries. For example, healthcare and technology have higher ratios compared to energy and telecommunications. Why? Because they have different growth profiles as well as capital needs. For example, healthcare and technology are considered high growth industries, so that people are willing to pay for higher multiples because hopefully the EBITDA will grow in the future, and then the ratio will come down if the enterprise value stay the same. And for telecommunications and energy, they are usually considered very steady and cyclic. So there is no secular growth, and they pay dividend. Especially for energy, it requires a lot of reinvest of its cash flow just to keep the EBITDA steady. So as a result, they usually command smaller ratios. Comparing the ratios across industries are informative, but do not necessarily tell us about if one industry is a better deal than investing in a different industry. Another set of information in this graph is the ratio changes over time. So the gray bars were the ratios in 2019, and the blue bars are the ratios using earnings forecasts for 2023. So what we see is except energy industry, all the other industries see their ratios went up. That's quite interesting because 2019 earnings were before the recession and the pandemic, and it was the 8-9 years into the last bull market, so the valuation was already pretty rich. And then the current ratios using the forecasted earning shows even richer valuations. So this tells me that except maybe a few industries. The market overall is very richly valued. High valuation levels don't necessarily mean that the stock price will come down. Why? Let's take a look at the historical S&P 500 earnings from 2006 to the estimated earnings in 2021 and 2022. What we see is that outside the recessions, for example, in 2008 and 2009 and last year, earnings usually grow. They have a long-term trend to grow. Even with the interruptions by recessions, they bounce back and they continue to grow higher than the earning levels before the recessions. So as a result, if we look at the price-earning ratio, even if the ratios are high, with the earning growth, then if the price stay constant, then that ratio will come down. This is also one of the reasons why stock price tend to go up over a long period of time, because those companies make more money. Some of the money, some of the higher earning is coming from compounding growth, but some additional contributors include inflation, because if let's say the money in 2 years is not worth as much as the money today, then we measure the earning in 2 years, then that inflation will play a role to inflate the earning. So that's why it's so important to understand the long-term inflation outlook. Of course, that's a very difficult subject, and there is a lot of debate currently. So I don't have the insight and knowledge. I just want to acknowledge that that is a factor to consider for a long-term investor like myself. Now let's take a look at the S&P 500 earning ratio over time, from the last Great Recession to 2020 and beyond. So the PE ratios are calculated by the stock price at the end of the year divided by the earning of that year. So it's considered a trailing 12 months. However, for year 2021 and 2022, the earnings are based on forecast, and the stock price is based on the stock price at a snapshot of time. For example, the thick line beyond 2020 was based on the price at the end of 2020, and the thin line beyond 2020 is based on the stock price in early April of 2021. And also, the earning estimates have been changing because we don't know the final numbers until the year ends. So the 2021 year-on-year earning growth were raised from 22% estimated at the end of 2020 to 26% estimated at the end of Q1 2021. So the estimated earning for 2021 has been going up, and in the meantime, S&P 500 went up 10% so far in 2021. So as a result, the ratio has also changed. That's why that thin gray line now is above the thick yellow line, which means that despite the economy is recovering and analysts are estimating higher earning in 2021, But due to the stock price increase of the 10% I just mentioned, the market valuation level actually went up slightly. So as a result, in, the earning growth is not necessarily bailing out the high PE ratio we currently see. The reason I think it's high is because at the P ratio about 24 to 25, and that's the highest point after the Great Recession in 2009. Usually, in the middle or right at the end of the recession, the P ratio is high because the trailing 12-month earning was reduced by the recession. And that's why we actually see a very big peak in 2008. Then, with the economy recovery, and the earning recovers very fast. And if the price doesn't increase that fast, then the P ratio will come down. And that's what we saw in 2010 and 2011. And then with the economic expansion in the last decade, the stock price continuously rose and the earning also rose. But the stock price rose faster than the earning growth. As a result, the market became progressively more expensive and reached 25 in 2017. With a slight dip in 2018, it bounced back over 2019. Of course, with the pandemic-induced recession, it went further up. What's interesting is that now we are coming out of the recession because of the very big stock price run up in 2020. The PE ratio actually didn't really come down that much. We stand at about 24, 25. That's the highest PE ratio over the last decade. Coming out of the recession, and historically, we should see a very low PE ratio. If we keep the similar trend of PE ratio growth from 2011 to 2017, then the PE ratio will reach 30. And that is very unrealistic. So the key takeaway is that the market currently is very richly priced. And the earning growth is not bailing out the current high market valuation. So what's the investment strategy given the high market valuation? So for me, I think the low hanging fruits, the explosive stock price increase will not repeat in 2021. What I expect is maybe a small increase and then either stay flat and wait for earning to catch up, or even experience a larger correction and with the valuation bubble burst and the stock price will crash. I have no idea which scenario will happen, but one thing for sure is that I will not chase the stock price increase. I will continue to focus on lower valued or fairly priced stocks. And since I expect the total market growth will be limited, I may even sell into stock price run up. So this concludes my review of the current market status and the valuation level. In next episode, I'm going to review the latest earning results from several companies I own. Until next time, happy investing.